Big changes are coming for high income earners saving for retirement. If you're 50 or older, new IRS rules will impact your 401k saving strategy starting in 2026. In this video, we'll explain what the new Roth catch-up contribution rule looks like, what's changing, who it affects, and what you can do now to prepare. Beginning on January 1st, 2026, we are seeing a pretty significant change to how 401ks are going to be administered, especially for those folks that are over the age of 50. Now, before we understand what the changes are, let's understand what the rules are now. If you are age 50 or older, you are eligible to make catch-up contributions. So this is going to be the amount above the standard limit. So in 2025, the standard limit was $23,000 of employee contributions to a 401k. In 2026, that jumps to $24,500. If you're over 50, you have this ability to make what are called catch-up contributions. And in 2025, that was $7,500. In 2026, that's going to be $8,000. Now, the big difference, and this is the Roth catch-up contribution rule change, is that any catch-up contributions going forward in 2026 and beyond are going to have to be allocated into a Roth bucket or a Roth account. Now, this might not seem like a huge deal, but there is a little bit more to the story here. And a lot of the times when you get those catch-up contributions, they're going to go into wherever the status quo is. So if you're saving into a traditional bucket of money or a traditional 401k, I should say, that money would go normally into that traditional bucket of money. So you'd continue that tax deferral for that catch-up. Well, in 2026, that changes. All of those catch-up contributions have to be allocated to a Roth. So effectively, the government is going to get their money today for those catch-up contributions. So it does limit that a little bit. Now, when I look at the big change long term, this is going to be some good, some bad. Now, again, you don't get the tax benefit today, but with that Roth contribution, you're going to pay tax on that money now, and that money is going to be tax deferred following the rules, the 5-year rule and a couple of other rules that you have to deal with Roths. But once you retire and once you're taking income in retirement after 59 and a half, you can take those funds out tax-free along with the growth. So that's a really nice benefit. But the interesting thing about this new rule change is it's going to be only for those folks making over $150,000. And they have a term for this. It's called highly paid individuals, or HPI. So these HPIs now can only contribute to that Roth bucket above the standard limit, and it's only for those folks that are making $150,000 or more. What I think that we should be aware of is what is going on in the 401k. So I've talked to a couple of different payroll providers as well as 401k providers, and there's a little bit of a mixed bag out there. There are a lot of folks that are going to just have this automatic Roth switch. So if you're enrolled in the 401k and you're making those catch-up contributions and you make $150,000 or more, then the payroll provider or the 401k provider will just automatically switch over to a Roth savings account. That's one setup. The other side is potentially where you have to manually elect that, where you have to actually go in and elect a Roth account if you have those catch-up contributions. And then there's a third one, which is once you reach that limit, regardless of your age, you're just going to be cut off. So it's something that you should actually go to your HR department and talk to their 401k provider to make sure that you're going to be able to continue making those contributions after you max out that contribution limit. So if you're making those catch-up contributions, you want to make sure that you understand where those dollars are going to be allocated and if you're going to be allowed to make those contributions within the framework of the 401k. So if you don't take action in advance, your retirement contributions could unintentionally pause once you hit that limit. So for you as the employee of the company, you need to take some steps here. So first, contact your 401k provider to ensure that everything's going to be smooth, especially if you're making those contribution limits. And this is a lot of the clients that we work with, is those highly compensated individuals. And most of our clients are making over $150,000. So if they're over 50, they're likely going to be affected by this plan change in a pretty dramatic way. And then confirm whether or not the 401k plan provides a Roth option. I'm seeing this more and more, that you have, as a standard operation procedure, that most 401k plans do provide the Roth option. However, there are some circumstances where I've seen where a 401k plan doesn't actually have a Roth contribution option. So that not only could affect your regular savings before you hit that limit, but it also could potentially affect your catch-up limits and whether or not you can actually save into a Roth bucket. And then understand how your provider is going to handle those changes. Again, is it going to be automatic where they just automatically divert those savings into the Roth, or do you actually have to manually make those changes on your own as far as setting up a Roth type of an account? And then we also want to evaluate what your elections are, what you're saving into the 401k before the end of 2025 to ensure that everything's in alignment in 2026. So why does this matter? I think it really matters to understand how the Roth is going to fit into your longer term plan, but it's also about missing contributions that could potentially delay retirement goals. I think that that's a big piece of the puzzle is just the unknown. And so don't go at it blindly. Take the steps, take the initiative to understand what is the options that you have. And if you need some help, we're here to help. At 4 Points Wealth, we want to work with you and help you understand all of the things that are going on in your life, because life is complicated. There are a lot of moving parts. There's a lot of irons in the fire, and we don't want the interruption in retirement savings to be one of those things that get you fouled up in your long-term retirement plans. If you need some help, schedule some time to meet with me directly to go over what your 401k plan options are, and we're happy to help.